Hi everyone, this is Alan Rosinski of Metro Manhattan Office Space. Good afternoon. The current pandemic is one of many disasters in recent years. By now, it has the worst death toll out of any disaster in modern history. That said, countries around the world have been dealing with natural disasters for a long time. Hurricanes, earthquakes, tsunamis, tornadoes, floods, volcanic eruptions, and others. In this video, I want to examine the impact of disasters on real estate in the United States, both residential and commercial. The findings may surprise you. This will be one of two videos that I will make on this topic, with an upcoming video discussing how disasters have shaped the evolution of New York City specifically. Let's start off with a question. If an area gets hit by a major hurricane, what do you think will happen to the prices of housing in that area? In other words, the value of property. Most people would expect the housing market in that region to crash. Displaced families, flood damage, damage to the exteriors, damage to the streets, city infrastructure, and electrical grid, etc. In the immediate aftermath, the property values do in fact plummet. It may take more than a year for a city to repair damage caused by a hurricane, and until that happens, the area can't begin to recover. Despite this grim outlook, I can tell you that after a few years, real estate prices in areas hit with natural disasters do tend to go up. Some of the reasons are not very intuitive, so let's talk about what would actually happen. At first, there's an exodus of people trying to leave the area to find food, shelter, and safety. People whose homes got damaged or destroyed would have to find temporary housing. Some people may have friends or relatives who could take them in, and other people may stay in hotels for several days until they have a better plan. The hotel industry benefits almost immediately, and not just from residents seeking shelter, but also from tradesmen and laborers, FEMA responders, and other government officials that are part of the overall emergency response. Despite the disaster, the nearby hotel industry would be doing relatively well. Now think about supplies. Many people will be short on food, personal care items, and other essentials. Stores will need to open and resupply as soon as possible to deal with the sudden demand. If a store wasn't damaged by the hurricane, it will benefit by supporting the community as it recovers. Most people can't afford to buy or mortgage a second home. It's likely that they'll need to rent an apartment or other temporary housing until they have better options, for instance, after they receive insurance benefits. In the meantime, this will cause housing rents to go up because of high demand and low supply. Most people would not want to leave their city or move to a different state. If the situation is really bad, they may consider moving to a nearby town. Since many people do this at once, the real estate prices in surrounding towns will go up. Again, this is just the action of supply and demand. Now, we've actually seen this with COVID. Many people living in large cities like New York City left for the suburbs and smaller nearby towns. This caused real estate prices in suburbs to skyrocket. A New York Times article from March 5th of this year mentions that bidding wars were becoming the norm and homes are selling within days of coming on the market. Open house events now have long lines. It mentions factors such as historically low mortgage rates, residents being tired of dealing with the pandemic, and the willingness of employers to embrace remote work. This situation would be strangely similar to many other disaster scenarios, just on a smaller scale compared to COVID. In all cases, people are responding naturally in ways that help them regain normal, healthy, enjoyable lives. Now let's get back to the main question of this video. What is the long-term effect on the value of real estate in regions that were affected by natural disasters? Repairs to houses and infrastructure can take a few years to complete, but in the period that follows, real estate prices will actually go up. In a 2010 study, the Federal Reserve Board of Dallas found out that a typical hurricane increased housing prices by 3 to 4% within 3 years. Let's talk about why this could happen. Along with repairs, a city makes improvements. They may improve internet and cell phone infrastructure, giving access to faster service. Homeowners may choose to perform various upgrades to their houses, many of which would be paid by their insurance companies. Streets will be cleaned up and new lighting will be installed. If damage is widespread, some cities may not have enough funds to handle all the repairs, so they may have to raise property taxes to acquire the additional necessary funding. After Hurricane Harvey in 2017, the mayor of Houston, Sylvester Turner, proposed increasing property taxes by 8.9% to cover the cost of rebuilding. He ended up not doing that because the federal government stepped in and offered the city $50 million in aid funding. Property taxes are mainly calculated based on property value. If property values go up, so will taxes, and in turn, income for city governments. As you can see, it's in a city's interest to keep neighborhoods well-maintained, beautiful, attractive for new residents and for businesses. Now, my specialty is commercial real estate, not residential. So how would commercial real estate be affected in a natural disaster scenario? You may not immediately think of landlords and business tenants that lease space in those buildings compared to people who are displaced or lost their homes. However, don't forget that companies are also employers. They provide income to a community, and that income is needed most after a major event like the one we're discussing in our scenario. If commercial buildings are damaged, companies can't operate, and some may even face bankruptcy. People employed by those companies may lose their only source of income. Because of this, even people whose homes weren't damaged may still face financial problems following a disaster. Now, there's some good news. Aside from dealing with immediate damage, building owners are required to carry many types of insurance, and damages caused by a natural disaster are typically covered. As you can imagine, insuring a building is not cheap. Most businesses will also carry what's called business interruption insurance, and it's usually required. Physical damage like flood or earthquake damage is covered by a separate policy, but business interruption insurance covers everything else, such as the funds to keep a business running, paying the mortgage, paying employees' taxes, loans, etc. This insurance proved its worth in 2018 after the damage caused by Hurricane Florence, where Morningstar credit rating agency identified $1.5 billion of securitized commercial mortgages that were at risk. But the situation ended up being controlled because companies that were involved had business interruption insurance. Interestingly, this insurance doesn't cover pandemics such as COVID, and that's one of the reasons why so many companies had to rely on government assistance to survive the loss of income that many of them had experienced. Damage from natural disasters has been increasing year after year. According to the International Disaster Database in Brussels, in the last 4 decades, the frequency of natural disasters has increased almost threefold, from about 1,300 events between 1975 and 1984 to 3,900 events between 2005 and 2014. In addition to that, Americans have more physical assets in vulnerable locations compared to where they were in the past. For instance, a lot of recent housing growth has occurred in coastal regions and in river floodplains, which are naturally at higher risk when hazardous weather events occur. Why would developers want to build properties in those locations? Ironically, because they're very desirable. Many people want to own waterfront properties or live in proximity to an ocean. From a business perspective, those markets show higher liquidity, no pun intended. They have high density of demand, and they give reliable returns on investments. It seems that people may have to contend with some kind of disasters in order to enjoy living in those otherwise beautiful areas. On a positive note, there has been data that suggests that developers and lenders who operate in high-risk communities have started to value improvements to buildings that make them far more likely to survive a natural disaster with minimal damage. In turn, many tenants are willing to pay a slight premium to live in a building that is considered extra safe for their families. From a purely economic point of view, the effect of natural disasters tends to be regional, and businesses in the affected areas typically recover quickly as they rebuild their property and replenish their inventories. According to Moody's Analytics, even a storm the size of Hurricane Harvey in 2017 only created an $8.5 billion gap in the economic output of the United States, a tiny fraction of the U.S. gross domestic product of $19 trillion in that year. I hope this video has given you a lot of new information to consider. If you live in an area where natural disasters tend to happen frequently, please take care and take all basic precaution to ensure that you and your family remain protected from the physical and economic harm in the worst-case scenario. As always, if you have any stories of your own or any disaster-related experiences to share, even if you live outside of the United States, I'd be happy to read them in the comments. If you found this content interesting or helpful, I'd be happy if you subscribe to my YouTube channel. You can always find me on Twitter. My Twitter handle is @MetroManhattan. Until the next time.